Welcome back. In this video, I'm going over how to read financial statements. Financial statements are a company's business reports. They're the income statement and balance sheet. Those are our two main financial statements. In this video, we're gonna go over the foundational basics. So you might even wanna save this video for later if you're really looking to analyze and understand financial statements. I'm actually doing a series for how to read financial statements, and I'd love to hear from you in the description below this video about why you're interested in being able to read financial statements. In this video, I'm going over the basics, but in my videos that follow, I'll be specifically addressing if you're looking at buying or selling a stock and how to analyze publicly traded companies' financial statements, as well as for small business owners, if you're looking at buying another smaller business or selling your own smaller business. This video goes over the basics. We can't get to analyzing financial statements for a purpose if we don't even understand how they work. And so that's what we're doing in this video. If you're new here, my name's Amanda. You're watching The Business Finance Coach. Welcome. This is where I simplify business to help you succeed because I'm a business coach committed to helping you manifest your deepest, truest vision for your business. As we rise, I believe that we have the power to create an environmentally and socially responsible world. And that's why I'm passionate about making this technical information accessible to you. If you're looking to get your accounting and taxes and business set up, I have a free spreadsheet template and basic training that I give away, as well as a program for those of you who are a little further along or are accounting and tax professionals. So be sure to check out the description below this video for links to all my stuff. So let's jump into how to read your financial statements. Financial statements, the word financial statements, it's just another word for business reports, and often the terms are used interchangeably. They're called financial statements because they're summarizing the accounting data of the company. Now, there are two main financial statements. The balance sheet report, that's kind of the top level financial statement, and then the income statement. These are our two main reports that give us the top level view of the company. In accounting software, companies have a ton more reports, but they're all different details and breaking out details within these two reports. So these two reports are always your starting point if you're trying to look at a company and get information from the financial statements. So here is my automated spreadsheet templates. Now, so the income statement, as it sounds, goes over income. What is income? Income you should think of as sales, right? The sales of what the business is in the business of doing. That's our income, the money we get. The reason most people start a business, right? Income. Now, I want you to notice something really important at the top of this report. It says for the year ending December 31st, 2020. And so one thing to really understand is that the income statement tells us profitability, right? Profitability, how profitable the company is over a period of time. Whereas the balance sheet report does not tell us how profitable the business is. The balance sheet report, if we look at that same date location, we can see as of December 31, 2020. So it's not the year ending 2020. This isn't telling us about the year. This is only telling us as of December 31st, 2020, that one day. Now, that day hasn't come yet when I'm recording this, but regardless, it's telling us one day in time. The balance sheet only represents one day in time, and therefore it's a snapshot of the financial ownership and liabilities of the company. It's a total picture of the value of the business as of this day. And if you think about it, Value is not something that you can represent over a period of time. You would say the value of my house based on the last survey that was done, the last analysis. You can't say, represent value except that it changed. If you think about the value of your bank account, well, that's going to depend, right, on what day it is and how much money is in your account. So that's the difference between the income statement and the balance sheet. These two main reports, they actually work together, and I'm going to show you that in one moment. But the income statement tells us how profitable a business is over time. The balance sheet tells us the value of the business based on how we record things in accounting. Now, we need to back up a second and talk a little bit more about how these reports work. And to do that, we need to step back to the accounting to begin with. If you remember, I said that the financial statements, these reports, are a summary of our accounting for the business. What is accounting? So accounting is the recording of everything that happens in the business that affects value. And to record all of these transactions in accounting, we use something called accounts, which is just a systematic categorization of everything that happens in the business that affects value. It's a way of systematizing things so that you're not recording things to, multiple different accounts when those things should be in one account. Now, when I teach people how to do this for their businesses, I recommend they be as specific as possible and not to use generic account listings. In my accounting solution for small business owners, my spreadsheet templates, this is the worksheet where you set up your accounts. And so you can see we have 5 different types here. We have income, that's the sales of the business. Expenses, that's the costs to do business, which is everything that a business spends in order to earn income. We have assets, which is everything the business owns. We have liabilities, which is everything the business owes. And lastly, we have owner's equity, which is the value of the owner's aspect in the business. Now, our financial statements summarize the totals of these accounts. Now, in reality, the accounting record may have thousands of accounts, but they're going to be in categories of accounts. For example, a company might have one account called software expenses. And within software expenses, if it's a big company, they could have thousands of individual accounts for different types of software that's used. Probably not thousands, let's say maybe 100 or hundreds or tens. 10, 20, 30, 40. But the point is that all these sum up to one account line on the report called software. So if we go back to our reports, here we are at the income statement. You can see the top section is revenue, sales and income. So this is where all of our summarized version of all of our sales or income accounts are listed. Now, if you're a small business, you might have one account, or a business might break out many accounts to describe sales. It's totally up to, what information the business owner or investors want to see when they look at the reports. So income's on the top. On the bottom is our expenses, the cost of earning that income. All expenses that you spend in a business, right, that you wouldn't otherwise spend that aren't personal, those are business expenses. And so they're deducted from the income, which gives us net business income or loss. And that's what the income statement tells us, right? How much sales we have, what was the cost of doing business, and the net income over this period of time. In this case, the year 2020. If we go to the balance sheet, on the other hand, we can see this first section is assets. Within assets, we have current or general assets and then fixed assets. Now, fixed assets are specifically things like real estate, computer, equipment, furniture, things that the business owns that they use to make money in the business, not things they're going to sell, that's inventory, not their bank accounts, that's a current asset. But fixed assets really represent things of value that the company uses, such as a company store, right? And real estate or equipment. So our first section on the balance sheet is assets. Then the second main section on the balance sheet is liabilities and owner's equity. And you can see within this section, we have our total liabilities. That's everything the business owes, like loans, credit cards, mortgages. And then owner's equity, which is everything attributed to the owners. So you can see our first two accounts are capital accounts for Sally. So as the owner of an LLC, if Sally puts money into the business, that's a capital contribution. And the money she takes out, regardless of what she thinks it is, whether it's her pay or she's repaying herself, that's draw. And then we have a special account called retained earnings. And that account, as it sounds, retained earnings, is the net income or net loss from each previous year that the business has been in business. So in this case, we're pretending that this business started in 2019. And in 2019, the business had net income from its income statement for 2019 of this number, $130,000. And that's how this ends up here. Now, the total of our liabilities and our owner's equity should be equal to our total assets. And you can see that up here. Total assets, 121.73. Total liabilities, 121.73. Now, my worksheet is set up to check this number, and you can see plug to balance, which is like the antithesis of accounting. You know, we never want to plug, but the reality is, after working in public accounting and for all sorts of big companies, is that plugging is a common way to get things to balance. And in reality, if you haven't been keeping perfect books, you're going to need to use a plug. So don't be super scared. Now, if you're submitting the statements, you know, to a bank or to a possible investor, I would not label this plug to balance. I would label this capital to, you know, so it blends in here. Not that you're trying to hide it, but it's just the proper place to put it is in capital under this account. So as you can see, our income statement and our balance sheet report, they may seem unrelated. Income statement has income accounts and expense accounts, tells us net income. The balance sheet has assets equals liabilities plus owner's equity accounts. But in that owner's equity section in the capital of the company, that is how our income statement is connected to the balance sheet or the snapshot of the value of the business. Because every year that's gone by, the net income from the business on that income statement gets funneled into the balance sheet report. Now, the reason this is this way and how it actually works in the accounting is because our income statement accounts are called temporary accounts. That means that at the start of each period, they start at zero. And that's how they're able to track how much income has been recorded for the month or the year or whatever period, right? And same thing with expenses. They start at zero at the start of the period, and they're temporary accounts because at the end of the period, they are going to get dumped out into an account called retained earnings on the balance sheet so that they can start at zero for the next period. On the other hand, our balance sheet accounts start at zero when the business is formed, and at any given point in time, they are a running, just up and down total of the activity that's happening. So at any point in time, you look at them, as of today, they have a balance, and that's it. And it shows a snapshot of the business, of the value of the business. The snapshot is everything the business owns, assets, equals everything the business owes, plus owner's equity. So this is an equation that the accounting records represent. And that's why our balance sheet accounts are called permanent accounts. They never start over at zero. They are permanent accounts. They start at zero when the business begins, and they're a representation of what's happened. They're cumulative. And whenever a transaction occurs, the equation assets equals liabilities plus owner's equity is always remains true because that's how our double entry accounting works. That's all for the foundations and the fundamentals of how these two statements work. Now, I want to show you something important on the income statement. And if I open up these lines here, my income statement is monthly. You can see here month by month, it shows the amounts in these accounts. So the basics of reviewing financial statements is to always compare one period to another. So generally, if you're looking at your income statement throughout the year, you're going to compare one month to the other. Oh, why was this month different from this month? That's the basis for analysis. Otherwise, you're just looking at it and you're like, yeah, okay, great. Like, what does this mean? So that's kind of the starting point for analysis, is to always be comparing to another period. Okay, the last important thing I want to explain about the income statement and the balance sheet is something you may be noticing right now, or you may not be, but there's a lot of subjectiveness that goes into how you make these reports look. Like I mentioned with income, you have to really decide what accounts does this business want to use. Whether you're the business owner working with an accountant, or you are looking at another company's financial statements, it's important to understand that this is subjective, right? People are choosing what accounts do we want to present here. So keep that in mind, whether it's for your own business or whether when we get into analyzing more, that's a subjective thing. What accounts do we want represented on the reports? And typically, if a company doesn't have ill intent, there's going to be a reason why. It's going to, for expenses, they're going to be things that represent the major activity of the business. You should get a good picture by looking at those expenses. Those are their top categories of expenses in the business. So that should tell you something about how the business operates. Same thing with the income accounts. That should tell you something about operations, because why would people running the business want to see these accounts broken out the way they are in the categories that they're in? Now, when it comes to the balance sheet, one takeaway here is that you can always see your fixed assets, things like real estate, equipment, things that are used in the business over time to make money, to run the business, even if those have been fully deducted for depreciation. And I have a video that goes over the balance sheet and assets in more detail, so check that out for more information on those specifics. But one thing to keep in mind is that even if you've written off your assets in full, they still show on the balance sheet. So you can always still see the value on the balance sheet. Now, when it comes to owner's equity accounts, that's always an interesting place to see what's really happening in a business, because the loss or big gains from a business is going to go to the owner's equity account. And if a business is a corporation or other type of business, that's where we're going to see owner draws as well. So we can see a lot of what's going on with the owners of the business and the net income or loss from a business in owner's equity. Okay, so that's all for the foundations of understanding how to read financial statements, what they represent, and how they work. I actually give away a free business spreadsheet template that I mentioned at the start, and it has an income statement, just like the one I showed you in my auto spreadsheet template, but this one is just set up for you to enter all of the numbers directly on this worksheet, which can be convenient if you're just trying to get things caught up, and it's free. So do check it out. It comes with a few other worksheets and things as well. Or to get the spreadsheet I went over in this video, do check out the description below for links to my accounting and tax solution. Otherwise, I'd love to hear from you in the comments below this video about what you're looking to understand how to read financial statements for. Is it for your business? What questions do you have? I'd love to hear from you. And if you're new here, do consider subscribing or give this video a like to let YouTube know if you enjoyed it. And if you are looking to support me, subscribing is a great way to do that as well. Otherwise, check out some of my other videos here around me, and I'll see you next time. Bye.